Holy macaroni, people. Just take a look at this chart. Look, if you had one shot or one opportunity to seize everything you ever wanted in one moment, would you capture it? Or would you just let it slip? Because you only get one shot. Do not miss your chance to blow. This opportunity comes once in a lifetime. Yo, you like that? You like what I did there? You're watching the Stock Market Briefing Show. This is where we navigate the financial markets through the lens of technical and intra-market analysis, and we have some fun too, so make sure to hit that thumbs up. It is greatly appreciated. We have some interesting stuff to talk about. Perhaps from a seasonality standpoint, we may be turning around here in the near future. We're going to talk about why that may be more than just seasonality, but bad breath. We're going to take a look at some other stuff like expected moves and so forth on today's Stock Market Briefing Show. So buckle up. Let's get into it. Alrighty, people, welcome back. Check the pinned comment if you want to download today's chart deck and have these pictures for free. And there's also information about the swing trade community and the brokerage that I like to use for swing trading. We're going to start off looking at the S&P 500. We're going to look over here at a special indicator over here, the RSI, the Relative Strength Index. And we're going to date back way over here to 2022 because we're going to be making some comparisons on other breadth indicators as well. And then how it's similar to what we're seeing right now. So are we about to see a potential correction in the market, a consolidation, or a steeper pullback? Okay, looking at the RSI, you can clearly see we have a high to a lower high, and price continues to just press forward, and it's coming into a very key level. A key level we'll talk about here momentarily. We've talked about in prior videos. Over here in 2020, going into 2022, you can see the market was continuing to press higher, but the RSI was telling us that it was weakening based off of this specific indicator. And well, what happened? It ended up playing out to the downside, and that's what created this 2022, or at least gave us some insight that there could be a bear market in 2022, amongst other things. Okay, so we have some weakening momentum here on this specific chart. But as far as a breadth perspective goes, if you look at the percent of stocks above the 50-day and the 200-day, and you date back to 2022 as well, what you'll notice here is something interesting, right? Price action keeps continuing to drive higher, but the percent of stocks above the 50-day are going lower and lower. So this means that the market is moving higher and higher on less and less stocks. And you can see the divergence there in the 200-day as well. Now, if you look back to 2022, we kind of had matching highs here, both in the 200-day and the 50-day percent of stocks above the moving average, but yet the S&P 500 did continue to press higher there as well. So as the market went higher, we didn't have the supporting breadth. Not quite as extravagant here, but if you were to look at the NDX, percent of stocks above the 50-day and the 200-day, it was more extravagant over here. How you can see a clear decline, lower highs here, and yet the NDX did make matching highs as well. And then if you look over here to the right of the screen, you can see this is dipping off while the market continues to press up. These divergences do eventually resolve. And yes, it's not just looking at negative divergences. You can look at the bottom over here in October 2022 to 2023, we were making matching lows to lower lows right here. But look at what breadth was doing. We had these extravagant lows over here, percent of stocks above the 250-day. But yet then when we made another low in 2023 here, you can see breadth has improved dramatically, putting in a higher low. And if you saw this, well, these were some of the things that we were talking about as those divergences played into this year. Into last year. It's 2024 now. Oh, man. If we take a look at the bullish percent index, this is the percent of stocks on buy signals based off of tic-tac-toe charts. I like to call them the point and figure charts. I'm so funny. But if we take a look over here at the 70 line, which means 70% of stocks are on buy signals, right? Or below 70% or above 70%. But typically when you get above the 70% marker and then it crosses back down below, you'll see here, and here, and here. And if you just look up to the top of the screen, you can get turbulence in the markets thereafter. Now, what I find interesting is that all these times we're playing out to the downside, but right here, the market has continued to press higher. So this to me is a little disconcerting. Now, to give you more focus points on breadth, this was posted by Jason. I believe he's from Sentiment Trader, but don't quote me on this. I think so because it was Sentiment Trader watermarked here. But basically, they're just highlighting that the S&P 500, after a greater than 1% daily gain, this came on the earnings, right? With Meta, with What else was up like crazy? Meta was the big one, Amazon, Apple, etc. Okay. It was a big week for earnings, and we'll get back to that. But this was with more declining stocks and advancing. So if you watch my Twitch live on that specific day, we were pointing out from a correlation standpoint, looking at the S&P 100 advancers and decliners, it was very interesting to see so many decliners, but yet there was few advancers really on a market day that was pressing higher and higher. And if you want to watch me live on Twitch, I should be on tomorrow. So follow me there to get notified when I do go live. Now they marked all the times that this has happened dating back to the 60s. And what you'll see here is it happened, the furthest time ago was the day, I believe, after the 1987 crash, right? We didn't get no crash over here, but that was the day after the 1987 crash, or the day prior to or going into it, right around there. And that's when we were seeing all that volatility. Then it goes into like the 1997, 1999 .com area where we're seeing that volatility, and then the crash took place. Prior to that, you have the 2008 financial crisis, and this was like very shortly before that the Fed stepped in. I think this is right around the time that they announced QE, right? But it didn't quite kick in at that particular time. And then you have off the 2020 bottom over here, and this is when the Fed stepped in fully, right? We had the full, and that was probably around August where we were getting some massive volatility, and then we continue to press higher. So it is interesting to see all this mega market cap names having, just insane amounts of market cap added to them in a single day, causing this big move. Now, from a seasonality perspective, and the reason why I'm pointing this out is because it has been in times of high volatility. From a seasonality perspective, pulling up a chart here from Gamma Lab, you can see this light green line is where we currently stand. And then you can see the days of the year over here. And we're tracking rather well. And we're coming into the point where there's a typically weakness from a seasonality perspective. It's typically here into going into the middle of February, right around that area. And then you get some weakness. So not only do we have these negative divergences building in breadth, in momentum, and we're seeing some stuff like this take place, we're also coming into a period of time where seasonality is against us. Now, as I stated, we're coming into a pretty interesting area for the S&P 500, and that interesting area happens to be a gigantic call wall over here at 5,000. So this can be a very difficult level, right? We've talked about this up down at 4,800, right? We talked about it at 4,900, where this level swelled up, and we were just kind of pinned in that area. And what it took was the gamma to roll off, or the expiration or OPEX, to free the market up a little bit to get some movement. So as it stands right now, this is that key level that we're kind of sitting at. So it's going to be hard to really overtake this and push further above it until we start to see some other stuff open up and get some expirations to take place. Now, this is also happening on the back of a rising yield, right? When 10-year yield rises, you typically can get weakness in these heavy growth names, which we've seen in the past, right? Like, think of it in simple terms as like when rates go up, right? Debt becomes more expensive. And if the company has, a lot of debt, is debt heavy, it could weigh, that's a very simplistic way of thinking about it. You can also pull up like a correlation chart. But in the last 2 days since we've really had the Fed, we had the Fed talk, we had some huge macro data, we had earnings, and then we had him just here on Sunday night. We're seeing last Sunday night for 60 minutes or whatever the show is. We've seen some very strong movements in just 2 days' time. And this type of volatility is a little disconcerting as well. In the last episode, we talked about like the banks that were seeing some massive volatility there as well, could potentially force the Fed's hand. We'll see what that takes place. If we take a look at the dollar, we've been talking about its defensive posturing, and the dollar's been firing off this is one of the better trades to be in for 2024 so far. And you can see the market's actually moving up alongside, which is also a little concerning because you typically get a stronger negative correlation. And you can see that here on this chart where we look at the correlation between the SPY and the dollar from a 15-day perspective, 30-day perspective, 90-day, 120, 180. And you'll see the longer we go out, the deeper negatively correlated it is. And then just in a recent trade, we've been more positive. And there is going to come a time that I would guess, just by looking through history here, this will go back into a negatively correlated state in the near future. Now, what I also find interesting as we're coming into this middle of February, where we're getting weakening breadth, is if you take a look at the expected moves for the SPX, the last week was right here, and we closed basically right on it, right? We had a $71.29 expected move in the S&P 500. And we came outside of it a little bit and we closed right there. The prior week, we closed right at the upper level of it as well. And then you could see the week prior, we closed kind of just outside of it, very slightly, but basically right on it. The prior week to that, we closed outside of it. So the market's been pretty efficient from this kind of expected move standpoint. But what I find interesting here is if you just take a look, we talked about like, look at the range here from the expected move standpoint, 71.29. And this right here, just by looking back through history is typically larger. And that to me wasn't concerning at all because we had all the macro reports, right? All the important data coming out. And then on top of that, it was the biggest week of earnings where you get, Meta, Amazon, Apple, etc. So this made sense to me. But what I find interesting here is now we're at a $69 expected move where the upper edge is right at around 50.27. The lower edge is at 48.99, but we don't have nearly the amount of information being dropped. Like we have some macro data coming out, right? Some macro data, but nothing. And we have Fed speak, but I do find that to be interesting. Like what is the market pricing in here? What does it see as far as risk? Maybe it has something to do with the Fed, but even from an earnings perspective, I mean, we don't have like anything, competing against that market capitalization that just reported. So that's a little interesting. If you do look also at the Fed Watch tool, and you look here, now we have an 84% probability we're going to keep rates to where they're at in March. And now May is starting to price in kind of a coin flip that we may hold rates there too as well. And yet the market hasn't really responded to this in the slightest. I mean, it keeps continuing to kind of float higher and higher. And, before while it was floating higher and higher is because people were saying, well, they're pricing in the rate cuts. Well, now are they going to start pricing in the rate to continue to pause? Now, as the market has continued to move up, we're talking about poor breadth. What's holding this market up? What's holding the market up? Today, you can see it was some healthcare names, right? LLY, Eli Lilly, and then NVDA has been a complete monster this entire year. So NVDA has been where kind of all that consolidated flow has been at, holding together this market, even amongst when you see all this red floating around. And the reason why I put this as the thumbnail is because a lot of people are going to say, hey, is this like the end of NVIDIA? Like, is it going to come down? And I just want to remind people just how exuberant, right, things could get and where things have been in the past. And when I look at this specific chart, I'm looking at CSCO Systems was the high flyer in the going into 2001. Now, I was younger back then, but I can tell you this, I was in 6th grade. My math teacher was talking about CSCO Systems. I remember it because this is when I started really getting into the financial markets, like from a younger perspective and kind of trying to learn it, right? And then it grew from there. But as it stands right now in NVIDIA 2024, I guarantee you there's a lot of people talking about a move like this, especially now that media has a lot larger spread amongst all various ages and, countries and so forth. But if this was to actually play out similar to CSCO Systems, what would that actually look like for NVIDIA? Well, I looked into it just to see, right? CSCO Systems over here did an 8-week consolidation, right? This was the October area right here, and then we started to see strength. October was the low right here. We started to see strength. We did consolidate for longer, but this little tight pocket over here was also 8 weeks. Once we broke out of that 8-week consolidation, CSCO Systems ran 121%. Okay, that was the high right there. And then NVIDIA, if it were to do something similar on these lines, I'm not saying that it's going to, I'm just making, I just think that this is really cool to look at, right? But if that was the case, that means NVIDIA can run up to around 1100, right? And right now it's at 680 and people are saying it's crazy. This is crazy. No, this is crazy right over here. And this can very well continue to be crazy. We're just kind of living within it as it stands. But what happened to CSCO Systems when the dot-com bubble blew? It took 20 to 23 years all the way to come back to meet that high. Okay, so is NVIDIA the CSCO Systems of its time? And you may think like, no way it's going to reach to 1,000. Well, but guess what? There's already people reaching for that strike that are already in the green. That's all I got for you on today's episode, everybody. Hope it enlightened you, gave you some laughs, and make sure to subscribe if you haven't done so already. I'll see you on the next episode.